Chapter 1, that's what I want to cover a little bit. You have a check-in assignment, discussion, problem videos. Those are awesome. As if I get time, always I like to go over those problem videos and at least watch few of those and explain a little bit more in between. There's a very good video here. I find out few last year, I believe. It's a very nice video, so I definitely suggest watching this video. Homework problems, maybe looks like we have here 4 homework problems and 1 quiz. And there is a video here for you. I recorded it already. That's about how to access publicly traded companies through SEC website, which is the actual source. And also how to find out where GAAP is, because we're going to talk about GAAP every time, and then you're going to say, okay, you're talking about GAAP every time, but what is it? Where can I see it? And in that video, I show where GAAP is located, so you can have access to it if you want. And also, I have another page here. We call it account types. And in these account types, you click, if you will see that those are things that you need to learn within next 1 week. So at the beginning, it will be a little bit challenging, but down the road, within the next 7 days, 10 days, you should be able to easily identify. Let's say if you look at the accounts payable, you have to know that, okay, accounts payable, it's a liability, obviously, in the classification of accounting equation. And the normal balance for any liability is credit. That means it will increase if you do credit. So normal balance for any liability, it's credit. Why? Because when you credit liability, it will increase. That's what we call it, normal balance. Accounts payable, normal balance is credit. Liability, normal balance, credit. Liability, normal balance, credit. Liability, normal balance, credit. You see how I'm going through? And you have to repeat this and kind of having a quiz from yourself to see if you have a good command on this or not, okay? So there are tons of information here that you like to eventually know. But the major thing is, first is, what is normal balance for any liability? Normal balance for any liability is credit. Liability, credit. Liability, credit. That means if you credit liability, the liability will increase. Accounts receivable, those are account services that you already provided, and you send an invoice, and now you are waiting for a check. Those are accounts receivable. Accounts receivable is an asset. And just like cash, it's almost like cash. So accounts receivable is an asset. And normal balance for any asset is debit. Normal balance for any asset, debit. Asset, debit, asset, debit. So just make sure you know what is the normal balance for asset, what is normal balance for liability, what is normal balance for expense. Expense, normal balance is debit. That means expense will increase if you do debit. Expense will increase if you do debit. For equity, let's say capital stock, that's an equity. What is normal balance for equity? Is credit. Equity, credit, equity, credit, equity, credit. So just get those few things done, and then all you need to do is just say, okay, is accounts receivable an asset? Yes, it is. Then normal balance is debit, obviously, right? Like building, is it an asset? Yes, building is an asset, right? And normal balance for asset is debit. Bonds payable, it's a liability. So normal balance for bonds payable is credit. So that easy. Any question on this normal balances that is confusing at this moment?
I have a question.
Mm-hmm.
For contra asset, does that mean you are paying money or losing money?
Very good question. Let me show you. So let me stop sharing here for a second, turn on my camera, but the other camera, this one. And I'm gonna put a pin on this. So you should be able to see my desk at this moment. Okay. Here we go. So you see, in accounting, we have a lot of T accounts. And every account has a name. Let's say cash has a name. Let's say building. T account has a name. And let's say accounts receivable has a name. So every account looks like a T and has a debit side and has a credit side, debit side, credit side, debit side, credit side, debit side, credit side, okay? And has a name. So debit is always on the left, credit is on the right. So now you say, let's say I have, for example, $100,000 of building, right? And I bought this building. Let's put some money in our account first. Let's say you say, okay, I have $1 million raised by issuing capital, common stock. So here we go. So you get cash, $1 million, and you issue common stock. Right? So 1 million in cash, you raise capital. There's two ways you can raise capital for any business. So that's either equity financing or debt financing, besides robbing a bank. So if you do equity financing, that's what you do. Common stock will be increased and cash will be increased because of that, right? And you might say, why is, anyone has a question why debit cash is on the debit side and common stock is the credit side? Anyone?
Because you want to keep cash close to you.
Oh yeah, you watched my video, right?
Yes.
Okay, so that whatever I explain in the video, like specifically that part, it's just between me and you, okay? Don't tell to anyone because no other teacher knows about this stuff. It's just a funny story, but it works. So here we go. I'm standing here, just quick again. So I have a debit always on the left side, credit on the right side. In accounting, always we have to do a debit and credit. That means whatever you record it, you have to put it in two places in order to keep the equation. Equation is asset equals liability plus equity. So whatever you do, you always need to keep this balance standing. So in order to keep the balance standing, you have to do two entries. We call it double entries. So here we go. Someone, I raised $100,000. Where do I put it? And as you said, I put it in my pocket close to me because I want to keep it safe. So I'm not going to put that $100,000 far away because it's going to go away and they're going to take it. Someone will take it. So I'm going to keep that asset, any asset, that asset goes in my pocket close to me. This is the closest. So I'm going to put that $1 million in debit because I want that to be close to me. As long as you understood that, that means every time you get an asset, put it in your pocket, keep it close to you. Okay, common sense. Okay, everyone can understand that. Okay, since you understood that, guess what? The other one will be $1 million credit automatically. All I need to do is just call it common stock. So far, so good. Any question? Okay, let's do one more. Now let's buy the building so I can answer the question that I had a few minutes ago. So here we go. Now I'm going to buy a building. So if I buy a building, I call it building because building is very easy to understand. That's why I choose accounting, because you don't need sophisticated English language. You just need basic English and you are good to go. So here we go. We have a building. We call it building. How much did I pay for it? $100,000, right? And how do I know it's a debit? Anyone?
Because eventually it'll be an asset. Is that why?
It's not eventually, it is an asset. Building is an asset. Cash is an asset. Car is an asset. Accounts receivable is an asset. Anything that you have has a value is an asset, has a future useful, benefit to you is an asset. So building is an asset. If I get an asset, guess what? I'm going to put it in my pocket, right? Because I'm standing here and the closest place I'm going to put the asset in my pocket. Okay, since that is an asset, the question is, how did I pay for it? Oh, I put 20% down payment. Very good. So this time, cash, which is an asset, is going out of my pocket, far away. Here we go. That's $20,000. Okay, cash goes out of my pocket, but that's not enough. Your debit and credit has to be equal. So here we go. We have another $80,000 that we have no choice to get a mortgage on that. So it says mortgage payable, and that ends up automatically on the credit side, no matter what I want to do. That's the only choice I have, because 100,000, I'm sure that's on the debit side because it's an asset, goes into my pocket. Cash goes out of my pocket is an asset. Is an asset, goes out of my pocket, far away. I'm not going to see it again. That's also a credit. So the $80,000, we call this plug-in. Plug-in. Plug-in, that means you have no choice. You have to plug it in $80,000 over there. Either you like it or not. And that's a liability. So what's the normal balance for liability? Credit, liability, credit, liability, credit, liability, credit. Normal balance for any asset, debit, asset, debit, asset, debit. So you are trying to practice your knowledge. So if every time you do a journal entry, you have to post this journal entry, post it. Post it to where? Post it to the T account. So by looking at the T account tomorrow, 6 months from now, you can see what's going on and what you have. So I already post the cash into cash. I already post the common stock into the common stock. So already it's posted. Now the next journal entry, building, has to be posted. So here is building, 100,000. That's a debit right there, debit. Cash, 20,000 credit. So here, cash is 20,000 credit. How much cash do I have now? Anyone? How much cash do I have? $980,000, right? 1 million minus 20. Mortgage payable. Mortgage payable. That's a credit. Do I have the T account? No, here we go. Mortgage payable, that's a liability, and that's on the credit side, right? On the credit side. So here we go. Okay, so now as you see, I raised capital to open a business. I bought a building, but by putting 20% down payment, the rest financing, right? And now a year, let's say forward, you are at the end of the year, you need to depreciate the building. Remember, when you buy a building, you journalize the building as capital expenditure. What is capital expenditure? That means an expense that you don't expense it immediately, but you capitalize it in order to depreciate it down the road at the end of each year and every period. You want to depreciate it later on and record expense later on. But for now, you capitalize it. Why do you capitalize something? Because the building, it doesn't have 1 year benefit. This building is 30 years benefit. So 30 years benefit, I'm not gonna expense it right now. GAAP says you cannot do that. If you have a building and it's gonna give you 30 years of benefit, you have to divide that building in 30 years and expense it little by little. We call it depreciation. Okay, so right now, this building is capitalized. But let's say you pay for utility, you pay for rent. Those payments are revenue expenditure. What is revenue expenditure? It's an expenditure that you expense it immediately because it is related to your daily business operation at that period. And you expense it immediately. You don't need to capitalize it. You only capitalize assets that has long-term benefit. So let's talk about this building. So the building has $100,000, no, 1 million, how much? 100,000, yes. $100,000 value minus residual value, which in this case, we assume it's 0. And that gives you depreciable base. And that's 100,000 divided by useful life, let's say 30 years, equals to $100,000 minus 0 residual value equals 100,000 divided by 30 years. That's $3,333. Okay, $3,333 annual depreciation expense that I need to recognize. Any question up to this point?
Professor, this is Kirsten Morris. I have a question.
Yes.
Do we not take into account the fact that of real estate and that property goes up in value usually over time? I mean, I know it can decrease, but.
Yes, the building value over time, it goes up. But based on GAAP says always record your assets based on like fixed asset, let's say building, automobile, machinery, equipment, based on historical cost under GAAP. Under
this case, historical cost is what you paid for it, or
yes.
Okay.
Yeah. But under IFRS, International Financial Reporting Standards, let's say you are an accountant in Europe. Under IFRS, you have the option to update your balance sheet assets, fixed assets, to present value in some cases. That gives you an option to do that in some cases. But overall, under GAAP, we don't do valuation update on the balance sheet. We just keep it as historical cost. And also, I just here kept it a little bit simple because the building is sitting on a land, okay? But I didn't talk about that because I don't want to make it too much complicated. But building on the land never depreciates. Land is always brand new. The only thing is depreciating is building. So technically, when you buy a building on a land, you have to appraise the land separately in a different T account, call it land. And then you appraise the building separately and you put it in a separate T account, you call it building. And then you only depreciate the building. You capitalize both of them, but you never ever depreciate your land, but you can depreciate your building. So you might have a land in your balance sheet for last 30 years, 40 years, still is sitting there, historical cost. Good question. Okay, let's imagine this is end of the year, and at the end of the year, I have to do some adjusting entries. So we call it adjusting entries of end of the year. The thing that I have here to adjust is my building. So I'm gonna call it depreciation expense, debit, $3,333 that I just calculated. And then normally you have to say building credit. Building credit, that means you remember here you bought building for the asset. Now your building is going down, right? Your building is getting old, is going down on the value. So, but GAAP says, because those are fixed assets, don't touch the T account. Let people see for next 30 years that how much building you have in your T account. Don't mess it up. Okay, if I don't mess this up, I mean, don't credit it to reduce it, then how do I reduce it? So GAAP says create a contra account, an opposite account, opposite of building. So we call it accumulated. Okay, there is just a short notice. There is a gardener every Monday that will come to very close to my building, and he's gonna make a noise. And probably at that point we take a, 5 minutes break. But for now, for next second, accumulated depreciation dash building, and that's $3,333 credit. And you see, I am crediting a contra account. This is where you were asking, what is contra account? This is a contra account. So now I'm posting this. This is accumulated depreciation dash building. That is a contra of building, which is on the credit side. And then I record depreciation expense. Now I have an expense finally at the end of the year. You see, I bought the building, I never record any expense, but now at the end of the year, finally I have something to record as expense because I paid for it, $100,000 for God's sake, right? So here we go. What is contra account? This is the contra account that you were asking me. This is the main account. This is the contra account. How much building do I have right now? Net building is $100,000 technically, minus $3,333. The gardener is here. Let's take. You good? Okay. So let's go to the chapter if you're okay for now.
I actually have a question. So the titles that you're giving these T accounts are coming from like whatever accounting we're doing, right? We're not just like titling them whatever we please.
You can kind of titling them whatever you please, as long as when you give it to anyone in this class, everyone can understand what you mean. For example, I titled this cash, right? In a real life, I call it cash dash BOA checking account. Why? Because my cash might be different cash, might be a Bank of America checking account, might be Bank of America saving account, and also I have a Chase checking account. And also I have, let's say, I don't know, another saving account somewhere else. So those are all cash, but here I just call it cash. I'm not specifically call it Bank of America checking cash or whatever, because I don't have a real business scenario going on right now, so I call it cash. However, let's say building, if you call it building, almost anyone on this planet can easily understand what building is. Accounts receivable, again, everyone understand that. Common stock, again, that's simple name, understandable. Mortgage payable, simple name, understandable. As long as the name makes sense, let's say maybe you call it mortgage payable, and maybe your friend calls it loan payable. Okay, loan payable or mortgage payable or note payable, they are all same thing. Make sense?
Yes, thank you so much.
Yeah. So you might change it a little bit, but overall should be just common sense. Everyone needs to be able to understand. Okay, if there is any question in this, because I covered tons of resources here that you need to utilize all of them. Let's say if you go to chapter 1, it says this is your textbook. Those are the things that we like you to cover in this chapter. And here is the Excel document that you need to download and practice whatever I do in here. So you download the Excel document, you watch the video. After you watch it, you do the same thing. You can even do the same thing while you are watching it. So watch like for 5 minutes, go on into your Excel document, do the same thing I did. Go watch another 5-10 minutes and then do the same thing. And piece by piece, go forward. Make sure at the end of 2 hours or 1 hour, whatever time you spend on this accounting cycle part 1 is a joke. Okay. If accounting cycle part 1, by watching this and practicing is not easy, you have to keep watching and practicing till it becomes to the point that you say, you know what, this is the easiest thing I've ever done so far. Okay. And also you need to know the normal balances again. Here is another link to that page. And then you go to your book. And when you get to the book area, there are problems. Some of these problems will be available in the video solutions that I was showing you in the module. So here is video problems videos. The problems solutions are here. Some, not all of them, some of them. But anyway, those are things that you really want to watch it carefully to make sure you understand how things are done in here. Those 3 things, goal achievements, fill in the blank, multiple choice. You need to practice over there before you do any homework assignment or anything. Because if you are doing wrong, you get a feedback and you try to learn from it, and you do it again, you get some feedback, you try to learn from it, and multiple choice, you get a feedback. Those are not graded for you to practice. You need to read the book, obviously. So read the book, watch those video problems, practice a little bit in here, and every page has a video lecture almost. Not every page, but most of it. So if you go to the next page, here we go. You see there's a lecture on this page already. So you have to read the page and then watch the lecture, okay? So in order to learn accounting, your best chance is your book. Normally accounting is hard to explain, but your book is what it is, the best source, reliable, written properly. You can read it several times if you like. Even one part of it you can read 10 times if you like. So you can just get the best resources from your book. So definitely read your book and then watch these recordings. And then the last thing you do is just doing homework and taking a quiz. Homework, I believe I gave you maybe a few options, a few chances to do. Sorry, the gardener is back again. to utilize all these tools. You cannot just say, you know what, I don't have time to read. I don't have time to watch these videos. I don't have either time to do any of these non-graded things in here. So how about if I just, just check a little bit, like for 5 minutes to see what's going on in the chapter and go do my homework and my quiz, and that's all I need to do, right? No, you cannot do it that way, because then you're going to mess up the whole thing. In your chapter, if you go to your homework, let's say homework number 1, for example, let me open it. And here says, okay, this is a problem. This problem by itself, sometimes it is in the video problem solutions anyway, possibly. I'm not guaranteed, but I'm saying possibly. So watching those video problem solutions, it will be a good idea before you do anything, because you never know, it might be one of your homework problems. And so it says solve this problem and then use your solution to answer a few questions. So I'm gonna ask a few questions to see if you did this or not. And here says shuffle answers, yes, okay. No time limit, multiple attempts, yes, like 2 times. So you can do it twice. You can do once, and if you mess up once, first time, and you got low grade, obviously it's telling you that, listen, you didn't read it, you didn't practice it, you didn't watch the videos, and you are trying to do shortcut. Because if you do all these things that I tell you to do, there is no way that on this homework you get less than 5. I mean, the information comes from the book. Everything is in the book, written properly, explained properly, and there are some resources that you can use to get the job done. So twice, okay? So here is the book. There are things that you can just understand the differences between financial accounting and managerial accounting, which is good. So practice those, read those areas to understand the differences. Financial accounting is for reporting to external users, people who are outside the company, investors, creditors. And managerial accounting is mostly focused on reporting to internal users, people who are already working in the company, like managers, and giving them a chance to make a good decision for the next action, that how to run the business and how to stay profitable and successful. So financial accounting is for outsiders, managerial accounting is for insiders. Again, at any time you don't follow me, please don't let me go, okay? Don't let me go. Stop me and ask me the question, because I don't know where and which part might be confusing for you. Here is explaining where is this accounting rules coming from, who is making them. Financial Accounting Standard Board, FASB, is making GAAP, and IFRS is the international accounting rules, which IASB is making IFRS. That's for companies outside US. What's the difference? Almost is similar, but GAAP is more rules based. That means gives you bright line rules to follow. However, IFRS is more about principles, more about professional judgment. I give you an example so you can kind of understand. Under GAAP, it says, let's say, if it is more than 90%, you do X, Y, Z. Okay, more than 90%, you do X, Y, Z. You see, it's a bright line rules. But under IFRS, it says, if it's majority, then you do X, Y, Z. Okay, what is majority? Is 80% majority? Is 90% majority? How about 75%? Is it majority? So you see, you have to use your professional judgment and based on principle. The principle is the majority. If you do majority, you do X, Y, Z. right? But US companies, corporations, those big corporations, they don't like that. They like to know exactly what the rule is so they can easily maneuver it. But under IFRS, big corporations cannot maneuver it because there is no bright line rules. It says majority. And just imagine, how do you want to, go over that thing and say, oh, it's not majority? Because as soon as you are on 51%, it is majority, right? And you have to do X, Y, Z. So it's harder to skip not doing things. But under GAAP, it is easier because it is providing you a bright line rules. And if you watch my video, you will see where GAAP is. And every time we are following GAAP rules when we are preparing finance. Do you know why we are following a specific rule when we are preparing financial statements? Anyone? No? No idea?
Is it so all accountants, exactly what you mentioned earlier, so all accountants can read what's going on?
Yes, because you might put numbers on a page and then say, I swear to God, everything on this page is 100% true. But then I'm looking at that page. Okay, numbers are true, but it's like a jungle. I don't understand what is what and why is there, right? So it's just like driving a car. When you come to US, you learn how to drive a car in the United States. Why? Because everyone has to follow the same rules, so we don't have an accident every other hour or so, right? So accounting is the same thing. You have to prepare your financial statements some way, somehow, that every single person can and able to understand what's going on, what you are doing, what is your income, what is your balance sheet, how much asset you have, how much equity you have, and how much liability you have. And then they can analyze it. They can understand, are you going to stay in the business? Are you going to have a good profit? Are you going to, be able to pay your liabilities? So all those stuff needs to be properly prepared. So that's why when you are an accountant, you have high focus on details. So that's why some people don't like accounting, because they don't like to focus. They like to do just basic. But an accountant is the smartest guy in the company. If there is few flies flying in the office, no one cares, but the accountant knows that there are 2 flies right now flying in the office. Accountant knows who is doing what and why. So everyone else is just in general focusing on their job. Accountant knows every single details to the bone. So that's why some people don't like accounting, because it needs constant focus. Okay, let's keep going. Here is the historical cost principle that one of you guys asked me just a few minutes ago. And this is what we follow, historical cost principle under GAAP. And that's the concept that many transactions and events are to be measured and reported at the acquisition cost, like the building that we purchased for $100,000, and that T account will stay there for the next 30 years or more, as long as we have that building. Someone says, oh, I like book. If you really want book, then you can buy the book right here, okay? Either PDF or printed version. You can buy it if you like. But other than that, this is awesome. Okay, let's go to next page. Here is some information about possibility of working in an accounting firm and what is a CPA and auditing and public accounting, internal auditors. So those are good stuff that you need to read just to understand the overall idea of accounting, and there's a video also over there. And ethics is the most important thing for accountant because everyone is relying on the accountants to be ethical people and provide reliable, up-to-date information in their financial reporting. So ethics is the most important thing for an accountant. Let's keep going. Accounting equation, I touched it a little bit. So this came from Italian merchant, Luca Pacioli, about 500 years ago. And he made this equation, and still we are using it up to this day. So assets, whatever we have, it's always equals to all our liabilities plus any equities you have. I give you an example here. Let's say I have a home in my town. The house that I have, it's $1 million house. So that's my asset. But I have, let's say, $400,000 mortgage on it at this moment. So that's my liability, $400,000. So the rest is my equity because it's already paid off. So $600,000 equity, $400,000 liability, and I have an asset for $1 million. So when I go to a bank, bank says, do you have any asset? I said, yes, $1 million asset. And then they say, do you have any equity on that? Yes, I do. It's $600,000 equity. And the banker says, oh, how about the 400? Do you have mortgage on it? Yes, I do. And then banker says, oh, we have very good rates. We can refinance your mortgage if you like and give you lower rate. And at that point, we might go do it or not. Depends on the rate that they offer. Any question on assets equals liability plus owner's equity?
I'm just trying to think of that in the real world. So in like the housing crisis in 2008, people would get these houses. So the asset would be like $1 million, but then it would be all liabilities on the other side.
Yes. That's the problem. So at that point, you say, okay, you have $1 million asset. How much equity do you have? Nothing. And the moment you say, I have no equity and it's $1 million liability, immediately I say, okay, let's calculate your solvency ratios. And as soon as I calculate your solvency ratios, I will realize that you are, even before 2008, let's say in 2007, okay? In 2007, you say, I have an asset here, $1 million house, liability is $1 million, and I have no equity on it. In 2007, and I will say, what? Let me calculate your solvency ratios. And I calculate your solvency ratios, and I see that those ratios are so scary. And in 2007, I can easily tell you that, you know what? I'm just telling you right now, I know everything looks perfect, but I'm telling you right now that you are one step away from being total bankrupt and file a bankruptcy. And you might say, no, it's 2007, like economy is booming. I'm doing so good. Banks are doing good. Everyone is doing good. And I will tell you, I'm telling you, in a year or 2 or 3, whatever, anything happens, the first person gonna go down is you. And boom, a year later, 2008 happens. And then you realize what I was telling you in 2007. And you know who was that person in 2007? Do you have any idea?
No.
That was me. I was that guy. I opened a $750,000 investment business, second business in 2007. And at that time, I was not highly educated. I had certificate in accounting, but just a simple certificate without any higher education knowledge and degrees. And that's what happened. So 2007, everything was fine, but I borrowed too much on my home equity. And I put that money in the business, second business. My first business was doing good. I opened the second business, but I didn't understand how to analyze ratios. The thing that you are trying to learn right now, if I knew that in 2007, I would never, ever do such a thing at that time. But I did it because I had no knowledge, because I didn't take a class like this that right now you are taking. So I opened the business. I was very good business manager. I was good in bookkeeping. I had a certificate in bookkeeping. I had my second business. I mean, everything was under control. The only thing was not there. It was my knowledge about analyzing business ratios. And a year forward, 2008 happened. And because I had no equity and I had a lot of liability here, to the point that I went complete bankrupt and I lost that $750,000 investment. And just so you know, maybe 9 years before that, I came to this country with about $5,000 in my pocket, and that's all I had. So in 1998, I had $5,000 in my pocket. In 2008, 10 years forward, I lost $750,000. I lost my rental properties and barely hold on to my residential house because I was sitting inside. They didn't went that much forward to take that from me. But everything comes from knowledge. So all I'm saying is this: whatever you are doing, either very good or very bad, it's all your actions. It's all on you. Same thing happened. The thing that happened to me because I didn't have the knowledge. I didn't have this basic knowledge that how to analyze ratios. So when you take this class, plus take it really seriously, because it will teach you some skills that will prevent big disasters in future. So what I did in 2009, after going complete bankrupt and losing almost every single thing, what I did, I went to GCC, Glendale Community College, in the middle of fall season, took 8 weeks, second 8 weeks, financial accounting, this class that I am teaching you right now. I took it and I came home and I told to my wife, listen, we are completely bankrupt, just so you know. But the good news is I'm going to college, I'm going to get educated, I'm going to get knowledge, and I will make sure that such a thing never, ever happens again. And here we go, 10 years forward, or so, like more than 10 years. But here we go, I'm teaching the same class in Pasadena City College. I'm teaching the same class in Glendale Community College. And when I took the first class in Glendale Community College, which is exact the same class I'm teaching you right now, in a matter of 2 weeks in the middle of class, it was 8 weeks class, just like you guys that you are taking it for 6 weeks, over there was 8 weeks, because it was 16 weeks semester, half of it is 8 weeks. So in the middle of 2 weeks, I decided to, you know what, this is what I'm gonna do. I'm gonna come back and teach this class in the same college that right now I'm sitting. So a few years forward, I was teaching at GCC, and then I started teaching at PCC and several other universities also. And then finally PCC took me as a full-time. Good stories, huh? Anyway, so we know what asset is, anything that has future benefit. Liability is anything that you owe to others. Equity is whatever it belongs to you and you don't have any liability on it. So your assets minus liabilities ends up to be your equity. And when you have a business, it's as a sole proprietorship, you call it owner's equity. If it is a corporation, you call it stockholders equity. So we have a business like sole proprietorship, which is one owner, has unlimited liability. They can sue you. If something happens, they can come after your house, after your boat, after your personal assets. But if you have a corporation, the corporation is covering you from possible lawsuits. They can come after corporation, but they cannot come after your personal assets. In a corporation, you also get dividend as a shareholder. So that's how the corporation is, paying some of its income and profit to the shareholders. So that's why when I say you create your portfolio, that's how you make money out of your portfolio investment as a form of dividend on a quarterly basis. What is retained earning? That is very kind of confusing part of in accounting. What is retained earning? Retained earning, that means retained profit, kept profit. What is that? That means that excess of corporation income over its dividend. So corporation has some income minus any dividend that pays to shareholders. Whatever is left, we put it in a T account. We call it retained earnings. If the corporation is brand new, the retained earning on the day one is 0. So if the corporation is brand new, the retained earning on day one is 0. Plus net income minus dividend becomes retained earnings at the end of the year. So beginning retained earning plus net income minus dividend becomes retained end retained earnings. Questions, please.
Professor, this is the question I was going to ask you, is related to retained earnings on the homework. And it was because it's a true or false. And it says that it's basically the net income less the dividends. But the reason I think I got it wrong, because when we do the calculation, we use the beginning retained earnings, right? Yes. And I felt like, so maybe I got it right. I don't know, because you don't let me see the answers, but this is my confusion, is like, I just want to make sure I understand it, in a test type question. If you say it's net income less dividends, then it's true that that's retained earnings. It's not calculating the beginning retained earnings.
No. One more time. Beginning retained earnings plus net income minus dividend equals end retained earnings. So you have to see what the question is, right? And but this is the concept. What is retained earning? Retained earnings is, if we're asking what is retained earning, this is the explanation: the excess of corporation's income over its dividend. But how do you get end retained earning? End retained earning is retained earning, beginning retained earning plus net income minus dividend equals end retained earning. So if that is the way written, then it is true. If it's not written that way, then it's false. Make sense?
Will you, like after a week or something, release the correct answers to that, or no?
No, I don't release correct answers, because those are exams and quizzes that I'm going to use in this thing, and all those answers and questions are copyrighted. That means you cannot say, oh guys, I don't have the answers because the teacher didn't give it to me. However, guess what? I have all the questions. And here we go. Let me copy and paste it in the internet for everyone. That is violation of copyright. So you cannot even share those questions with anyone. And obviously, I will not share the answers with you. Everything is copyrighted. If you want to practice it, here we go. I just told you where to go for practice.
No, that's totally fine. And because we're studying accounting and ethics, I'm not concerned about myself doing that. I want to make sure I know which one I got wrong. So, okay, but that's fine.
Yeah, I believe at the at the end, after you submit twice, you might get a feedback which one was wrong. But the fact that I say, okay, this is correct answers, no. And I cannot even give you the correct answers because first, we are in the middle of quiz. Second, those questions might be used. But if you like to practice something and get a feedback, here, quiz. Start the quiz, get a feedback, correct answer, right answers, go field bank, multiple choice. All those three are over there for you to practice, to share, to do whatever you want to do. Everything is free for you over here. But when it comes to exam or quiz, no, then those are protected. Okay, so that's why I said always practice over there before you go to homework. Because when you practice over there, when you get to homework, you're going to say, oh, are you kidding me? This is so easy. Why? Because you already practice it. But if you go straight to the homework, if it's going to be a hard process because you're going to say, well, wait a moment, everything is confusing here. Okay, so balance sheet, again, balance sheet is a financial statement that presents a company's assets, liabilities, and equity at a specific point in time. So balance sheet, if you look in a balance sheet, it says as of. That means as of this date, not tomorrow, not yesterday, but as of this date. So balance sheet is a specific point in time for all those assets, liabilities, and equities. So here's an example of balance sheet. As you see, it says December 31st, 2013, or as of December 31st, 2013. Either way is fine. So company name at the top, name of the report in the middle, and proper date. Assets are all on the, let's say, left side. If you like to put it next to each other, assets on the left side, and then liabilities on the right side. Or you can put everything under each other. That's either way is fine. So your assets, add them up with a dollar sign. No more dollar sign all the way to the end, dollar sign double line, and that's your total asset. And then your liabilities, again, comes with a dollar sign. That's your total liabilities. And then you go to stockholders' equity. Stockholders' equity is always two-part, at the minimum, two-part. The capital stock, if it's a corporation, and retained earning, which is any leftover profit after paying dividends. Retained earning is a dollar amount that the company can retain for future use. The future use might be paying more dividend or buying new equipment, anything they want to do with the retained earning in future. And then that ends up to be 720 if you add them up. And then add up liability plus equity, which is 175 plus 720, ends up to be exactly 895, dollar sign, double line. And as you see, your assets are equals to your liabilities. So in this case, if I give you this part, you can tell me how much asset you have. If I give you asset and I give you liability, then you can easily tell me how much equity I have. So either one of them, if it's missing in a problem, you can easily calculate with the simple algebra. If it's a sole proprietorship, the sole proprietorship here, you call it owner's equity, and you have just one T account. You call it owner's capital. Owner's capital, and that's just one T account. There is no retained earning or anything like that. So in a sole proprietorship, you just have owner's capital. If it's a partnership, then you have Robert's capital and James capital. There are two capitals, Robert's capital and James capital. If it's a sole proprietorship, just Robert's capital. There is no retained earning in sole proprietorship. So you might say, okay, let's say there's no retained earning in sole proprietorship, but where is that leftover profit going? All the profit goes in the owner's capital. Simple as that. Every single profit goes in the owner's capital. So what is the Robert's capital and Robert's capital balance? So Robert's capital is beginning Robert's capital plus net income minus Robert's withdrawal equals end Robert's capital. You see, everything will be, income will be added to the capital and withdrawal will be deducted from capital. What is withdrawal? Because it's a sole proprietorship, the owner can, anytime he likes, go to bank and withdraw some money and go to vacation, whatever. So that withdrawal will reduce the owner's capital. So there is no retained earning, there is no dividend. Okay, but in a corporation, we have dividend, we have retained earnings. Why? Because corporation doesn't belong to one person. Corporation normal, you have a lot of shareholders. And in a corporation, they file taxes and then they pay taxes. But when shareholders get dividend, they pay taxes for the dividend again. That's why under a corporation, we call it double taxation. Because one time the corporation gets taxed, and then after paying dividend, whoever got the dividend gets taxed again. So that's a double taxation for a C corporation. Questions? So as you see here, there are some transactions that is going on if you read it, and those transactions are increasing. Let's say one account, in this case, cash is increasing, and because they collect accounts receivable, so accounts receivable is decreasing. So cash goes up, and accounts receivable before was 50, and accounts receivable goes down. So every time you are recording a transaction, you make sure that there is a double entry to record for this transaction. You have to have impact in two places in order to keep the accounting equation equal. There's another scenario here, which they bought an equipment by borrowing. So again, here you see the equipment goes up by $30,000 to 280, from 250 to 280. But in the same time, the liability also goes up by $30,000 from 125 to 155. So still the equation is equal, but just the numbers are changed. So this is a double entry transaction in accounting. Any question for me, please? Okay. Here they have a revenue. So accounts, they provide a job. After job is completed and the revenue is earned, then they send an invoice to client. The moment you send an invoice to a client, that means you are recording an accounts receivable. And the retained earning, that means the revenue is going up. If the revenue goes up, that means eventually your retained earning goes up. Do you remember what was the retained earning formula? The retained earning formula was beginning retained earning plus net income. Beginning retained earning plus net income minus dividend equals end retained earning. So here beginning retained earning is 600,000 plus income, net income, 5,000 minus dividend of 0, let's say in this case, and retained earning is 605. So in this example, if I tell you this is what happens, they increase the accounts receivable, they send an invoice to a client for $5,000. What is the effect on retained earning? The effect on retained earning is 600,000 beginning retained earning plus 5,000 net income minus 0 dividend equals end retained earning of 605. So 605 is the correct answer. Questions?
I have a question.
Mhm.
So you said on the first day that a corporation starts, retained earnings is 0.
Mhm.
So is it capital stock that has money in it? That's how a corporation begins. You have capital stock that's like investors put in 100,000.
Yeah,
Is
you
that-
see that 120,000 capital stock? That was probably, I'm not sure, but probably at the beginning of the business. How do you want to start a business? You need money. So what you do, you go to, let's say, 6 friends that you have, 6 friends, everyone puts $20,000 and you issue stock for $120,000. Everyone gets a certificate for $20,000 share of capital stock. And now you have 6 friends, everyone 20,000. All of a sudden you have $120,000 capital stock, and that $120,000 cash goes in the cash right there. So here you have $120,000 cash, and you have capital stock of $120,000. And then with that $120,000 cash, you start running your business, buying building, buying equipment, paying for utilities, paying for rent, everything else.
Okay, that makes sense. Thank you.
Okay, questions? Don't be shy. I am covering a lot of information, so please ask. Okay. So in this case, this one we are spending $3,000 for some reason. What is the reason? Expense paid $3,000 for expenses. We don't know what the expense is, but we just know general expenses, something, utilities, rent, or whatever. So here we go. For you to understand, cash is going down by $3,000. So the journal entry is cash credit, goes out of your pocket, right? So we credit cash to push the cash down. And that will record it as expense, let's say rent expense, utility expense, something. And that expense, eventually, the expense will reduce your net income. Agreed? So when you spend $3,000, not only your cash goes down, but eventually your retained earning goes down also. Why? Very easy. Beginning retained earning plus net income, which is in this case minus 3,000, minus dividend equals end retained earning. Imagine the dividend is not declared yet, 0 dividend. So 605 minus $3,000 loss on this business will become retained earning 602. But if you remember, previously we had $5,000 profit revenue here, remember? So your revenue of 5,000 minus 3,000, so your net income technically at this point is 2,000. So if someone says, what is the net income? I say, okay, net income is $5,000 revenue minus $3,000 expense. So net income is like 2,000, right? So watch this, 600,000 beginning retained earning plus net income 2,000 minus 0 dividend. What is the answer? 600 plus 2,000 net income minus 0 dividend. The answer is 602. You see? Retained earning is 602. Yes, here it was 605 because I didn't consider the expense yet. But after considering the expense, so the retained earning is 602. So revenue minus expense, bottom line is income, which is 5,000 minus 3,000 expense, gives you $2,000 income. Cool? And here it's your turn to look at the financial statements next to each other. Financial statements, the very first one, it starts with income statement, always. Income statement is number one. We need to calculate what is our net income. So revenues with a dollar sign, total 765. Every time you have a number in the column, the first number needs a dollar sign. You see the 765 is the first number in the column, it's a dollar sign. 750 is the first number in the column, it's a dollar sign. Okay, so total revenue is 765. Minus expenses of 650. So you put the expenses on the left side, you add them up, put the cute number on the right side, and then here is less traffic. So 765 minus 650 expense gives you net income of $115,000, double line dollar sign. And why this is number one? Because you're gonna use this 115 in the statements of retained earning. So statements of retained earning will be number two. That's what you prepare. So let's go to statement of retained earning. Here is the statement of retained earnings. Company name at the top, name of the report in the middle, and proper date. This is a date that says for the year ending December 31st. That means this is for the last 12 months. Last 12 months, result of last 12 months. So in last 12 months, the retained earning beginning was $400,000 plus net income of $115,000 less dividend of $35,000 gives you end retained earning of $480,000. Cool? This is how you calculate your retained earning at the end in the statements of retained earning. Report number 2. Questions? Perfect. Okay, report number 3 is your balance sheet. So your balance sheet is a moment in time, snapshot picture. So you put your assets, add them up. Total asset is 900,000. Anyone knows why cash is at the top? Why accounts receivable is at the top? Why land and building is at the bottom? No? Okay, cash, you always start with the most liquid asset at the top. Most liquid asset at the top. Cash is the most liquid. Accounts receivable is the next liquid. Inventory is kind of liquid, right? Those are current assets. What is current asset? Asset that can be converted to cash in a matter of a year or less. So those are most liquid assets, current asset. Land, building, equipment, those are fixed asset. They go next. So current asset at the top and then fixed asset at the bottom. Liabilities, anything that needs to be paid within next year goes at the top. So salaries payable, accounts payable, they go at the top. If there is mortgage payable, then mortgage payable goes at the bottom after accounts payable. But any most recent liabilities that needs to be paid within next year or less, those are current liabilities, they go at the top. Stockholders equity, they have two parts at the minimum, and the first one is the capital stock. The second one is retained earning. Retained earning, how much is it? 480. Where is that coming from? That is coming from number 2. And here is the report number 2. So that's why you have to do report number 2 before you can prepare that 480. So if you go to this box in the Excel, you say equals to, and then you click this box here, and then click enter. And then $480,000 will pop up in here. How about here? The net income. How do you get the net income in here? If let's say you are in Excel, you say equals to, then you go up, you click that box, and then you click enter. And then 115 will pop up there. Any question in regards to report number 1, 2, and 3? Okay, the report number 4 is the cash flow statement. We have a chapter for the cash flow statement by itself, but for now, it's just so you know, the cash flow is 3 parts: operating activities, cash flow, investing activities, cash flow, and financing activities, cash flow. We have 3 types of reason that a dollar comes into business or goes out of business. Number 1, operating activities. You sell products, you pay for rent, you pay for utilities, you sell product again. So cash comes in for those reasons, or cash goes out for those daily business activities. So total operating activities, here says cash provided by operating activities is $80,000. Okay, watch. The net income here says, 115,000, right? Net income says 115,000. But when you look at the cash flow for operating activities, you see only is 80,000. So you see cash flow is different than net income. Why? Because the income statement is prepared based on what you earned. We have 2 types of accounting method. We have cash method of accounting. We have accrual method of accounting. Under cash method of accounting, you have $80,000 operating. Under cash method of accounting, you have $80,000 net income. You only record revenue when you get paid. You only record expense when you pay for those expenses. However, in accounting for big corporations, for big businesses, we don't follow cash method because cash method sometimes doesn't show the exact picture. So under GAAP says, I don't want cash method. I want you to prepare your financial statements under accrual method. And under accrual method, when the job is done and completed and the performance obligations has been satisfied, you send an invoice and you record the revenue. Doesn't matter when the cash will be paid. You record your revenue when the performance obligation has been satisfied, job is completed, you send an invoice, record your revenue. And because of that, my revenue here is $765,000. I'm not saying I got all the cash from the customers, but all I'm saying is I earned $765,000 of revenue. In regards to expenses, you record expense when you have the obligation to pay. That means you receive goods or services and you have obligation to pay for those goods or services. So as soon as you have the obligation to pay, you record the expense. I don't care if you paid it or not. Under GAAP, under accrual method, you record expense moment you have the obligation to pay. Let's say people work for you and you have obligation to pay salaries, you record salaries. This $235,000 salary doesn't mean they paid it. It means they have to pay it. Rent is $115,000 expense. It doesn't mean they already paid for it. They might pay only $100,000. but another $15,000 still they have to pay, but doesn't matter. You record the expense. Under GAAP, it says whatever happens in 2019, in this example, whatever happens in 2019 stays in 2019, just like Vegas. Make sense? Whatever happens in 2019 has to be recognized in 2019, including all salaries, rents, anything. So if you do accrual method of accounting, the net income is 115. If you do cash method of accounting, which small businesses sometimes do, right? Under small businesses, cash method of accounting, the net income would have been what? 80. So what is this 80? This 80 is converting the accrual net income to cash method of net income. That's what you are doing. But if you have any investing activities to invest in building, land, equipment for long term, that is cash going out or coming in because you sold those equipment or you bought a new equipment. Any cash goes in and out goes in here for investing activities. But when you want to run your business, you need to finance it. So any reason that money comes in or goes out in regards to financing of your business, that will become part of your financing activities. In this case, in this period, you paid some dividend, and dividend are paid because you did equity financing, you raised capital stock, and you raised cash, and now it's time to pay dividend. Okay, payments of dividend is a negative cash flow. And then you add them up. Total decrease or increase in cash will show in here. In this case, is a decrease. Then you say, okay, at the beginning of the year, I had $397,000. So minus 205,000 negative cash outflow. So my cash at the December 31st is $192,000. Watch this carefully. Your cash at the end of December 31st of 2019 should be $192,000. And let me check. Oh, yes. Here we go. Cash is $192,000 at the end of December 31st of 2019. So did I do a good job in here? Perfect. Why? Because this number, $192,000 cash at the end of December 31st, is exactly matching what I did in my balance sheet, what I have in my balance sheet. Questions, please. Nothing? Okay. Okay, so it looks like I'm done as far as I think. So let's just make sure. Yes. So the next chapter 2 and 3 has to be covered in this week, which will become our busy day on Wednesday. Ask, don't come blank in the Zoom meeting, because then you don't know what you don't know, and therefore you're not going to ask any question. So read chapter 2 and 3, and we go over that on Wednesday. We have to push it a little bit fast and go over these videos that we have at the end of each module. So module 1, those are problem videos that you want to watch, definitely. Practice a little bit in those non-graded quizzes, like multiple choice type of things in the book. And after you are ready, then you start doing your homework and quiz. In chapter 1, I have already accounting cycle part 1 for you with the Excel document to practice. And then in chapter 2, which is module 2, you have to go over accounting cycle part 2. Part 1 is already covered. You practice it. it's piece of cake. Now you continue working on your Excel document. So when your Excel document, you're completing it, make sure every time you save it, because you have to continue working on that Excel document. You watch the video and then you work on your Excel document. After all these 4 parts of videos are covered, you need to be able to finish this Excel document the way I did it from beginning to end in less than 1 hour. And that will kind of give you knowledge and give you enough information to make sure you know everything in chapter 1 through 4, and you can easily manage your exam 1. Again, for this week, things that every accounting office is doing, they identify and analyze the transaction first, which we talked about that today a lot. Then you try to learn how to record the transaction as a form of journal entry, which I did it for you today, few journal entries in here. I did also post those journal entries into the general ledger in the T account. So what is general ledger? General ledger is a place that there are a lot of T accounts inside. And then in the future videos in chapter 2 and 3, you will learn that you need to prepare an unadjusted trial balance and do some adjusting entries. I did do an adjusting entries for you today in regards to recognition of building that has been depreciated. After adjusting entries are done, you prepare adjusted trial balance. Here is unadjusted trial balance, but here you prepare adjusted trial balance. Adjusted trial balance, it's a balance of every single T account after adjustment. Using adjusted trial balance, you can prepare your financial statements, which today I covered all those financial statements from number 1 to number 2 to number 3 and number 4. At the end of the year, normally those temporary accounts like revenue and expenses that belong to 2019 will be closed. Remember one more time, anything belongs to 2019 stays in 2019. So all those revenues and expenses that belongs to 2019 will be closed and will be converted to 0. Why? Because next year, in 2010, when you come back and you try to identify the new transactions, your revenues and expenses are already 0 and you start fresh.